Imagine waking up one morning in America and realizing that the bank you trusted your entire life is more nervous than you are, not because of war, not because of recession, but because of a digital asset that didn't even exist 15 years ago, Bitcoin. In 2026, U.S. banks are not just watching Bitcoin anymore, they are quietly afraid of it. And this fear is not coming from headlines, it's coming from inside their own balance sheets. This story starts long before Bitcoin became a household name. For decades, American banks controlled money. They decided who could open accounts, who could get loans, how fast money could move, and how much it would cost you just to access your own cash. This system worked perfectly for banks because it made them the gatekeepers of financial life. Then Bitcoin showed up with a dangerous idea: money without permission. No bank manager, no office hours, no approval process, just math, code, and a global network that never sleeps. At first, U.S. banks laughed. They called it fake money, internet coins, a bubble that would pop. But in 2026, no one in the banking world is laughing anymore, because something unexpected happened. Bitcoin didn't die. It survived crashes, bans, scams, and media attacks. Every time it was declared dead, it came back stronger. And now, American banks see a pattern that scares them deeply. Younger Americans don't trust banks the way their parents did. Millennials and Gen Z grew up watching bank bailouts, hidden fees, frozen accounts, and inflation eating away their savings. They saw banks get rescued while ordinary people lost homes and jobs. Bitcoin, on the other hand, told a simple story: fixed supply, transparent rules, no central authority that can print more overnight. In 2026, this story is resonating more than ever. Inflation may not dominate headlines every day, but Americans feel it when groceries cost more, rent goes up, and savings accounts barely earn anything. Banks promise safety, but safety that slowly loses value doesn't feel safe anymore. This is where fear begins for U.S. banks. Bitcoin offers an alternative savings technology, not perfect, not risk-free, but independent. And independence is the enemy of traditional banking power. Another reason banks are scared is control. Banks operate on the ability to monitor, delay, and sometimes deny transactions. Bitcoin doesn't ask for permission. A teenager with a phone can send value across borders in minutes without a bank, without paperwork. For banks, this is not innovation, it's disruption. In 2026, stablecoins and crypto rails are already faster than many traditional banking systems. When Americans compare a slow wire transfer to instant Bitcoin settlement, questions start forming. Why does my bank take days when technology can do it in minutes? Why are fees so high? Why can accounts be frozen so easily? These questions are dangerous because once people start asking them, trust begins to crack, and banks survive on trust. There's also the balance sheet problem. Many U.S. banks hold long-term assets that depend on stable monetary policy. Bitcoin introduces uncertainty into that world. When large institutions, hedge funds, and even corporations allocate a portion of their treasury into Bitcoin, banks notice, because that's capital not sitting in traditional deposits. Less deposits mean less power. Less power means thinner margins. In 2026, banks are under pressure from fintech, from regulations, and now from decentralized money. Another fear banks won't say out loud is transparency. Bitcoin runs on a public ledger. Every transaction is recorded. You can verify supply. You can audit the system in real time. Compare that to banks, where decisions happen behind closed doors and risks are often hidden until it's too late. After 2008, Americans learned a painful lesson. Banks can fail, and when they do, taxpayers pay the price. Bitcoin was born from that crisis, and its message still echoes in 2026. Don't trust, verify. That slogan alone challenges the very foundation of banking culture. Then there's regulation. Banks often argue that Bitcoin is risky and needs strict oversight. But behind that argument is fear of losing monopoly. If Bitcoin becomes too integrated, banks lose their exclusive role as money intermediaries. In 2026, U.S. regulators walk a careful line. They don't want to kill innovation, but they also don't want banks to collapse. This tension creates uncertainty, and banks hate uncertainty. Bitcoin doesn't care about board meetings or policy delays. It keeps producing blocks every 10 minutes, silently proving reliability. Another reason banks are scared is global competition. Bitcoin is not American, Chinese, or European. It's global. While U.S. banks are tied to domestic rules, Bitcoin moves freely across borders. Immigrants, freelancers, and international businesses are already using crypto rails because they're cheaper and faster. If this trend accelerates, banks risk becoming slow middlemen in a fast digital world. In 2026, speed is power, and Bitcoin is fast. But perhaps the biggest fear is psychological. Once people experience true financial sovereignty, it's hard to go back. Holding Bitcoin means you control your money. No bank holidays, no withdrawal limits, no sudden account closures. For banks, this is terrifying because it removes dependence, and dependence is how banks keep customers locked in. That's why in 2026, you see banks launching crypto products, ETFs, and custody services. Not because they love Bitcoin, but because they fear being left behind. They want exposure without losing control. But Bitcoin's core idea doesn't change just because Wall Street adopts it. It still exists outside the banking system. And that's the paradox U.S. banks face in 2026. If they fight Bitcoin, they look outdated. If they embrace it, they weaken their own dominance. This silent conflict is reshaping American finance right now. And this is only the beginning. Because the real question is not whether banks are scared of Bitcoin. The real question is what happens when everyday Americans stop being scared of it too.
When everyday Americans stop being scared of Bitcoin, the balance of power quietly shifts. In 2026, this shift is no longer theoretical. It's happening slowly, account by account, paycheck by paycheck. People are not abandoning banks overnight, but they are questioning them in ways that never happened before. And banks feel this change before it shows up in official reports. They see it when younger customers keep lower balances. They see it when money moves out faster than it comes in. They see it when customers treat banks like temporary tools instead of lifelong partners. Bitcoin plays a key role in this mindset change. It introduces the idea that money can exist outside institutions. That idea alone is dangerous for a system built on dependency. In America, banks were never just places to store money. They were symbols of stability. But symbols lose power when alternatives feel more reliable. In 2026, Bitcoin is no longer seen only as a speculative asset. It's increasingly viewed as digital property, something you own, not something someone owes you. This distinction matters deeply. Money in a bank is technically a liability of the bank. Money in Bitcoin is not owed by anyone. You hold it directly. For banks, this is a philosophical threat as much as a financial one. Another layer of fear comes from technology itself. Bitcoin is not standing still. Second-layer solutions, payment channels, and financial tools built on top of it are making it more usable. In 2026, sending Bitcoin doesn't always feel slow or expensive anymore. For everyday Americans, the user experience is improving. Apps are simpler. Wallets feel more intuitive. This reduces friction, and friction is what keeps people loyal to traditional systems. Banks understand this well. That's why they invest heavily in apps and interfaces. But there's a problem. No matter how good a banking app looks, it still operates under old rules. Accounts can still be frozen. Transactions can still be reversed. Policies can still change overnight. Bitcoin doesn't work that way. Its rules are predictable, and predictability builds confidence. Banks also fear narrative power. Stories shape behavior. For decades, the story was simple. Save money in a bank. Invest through approved channels. trust the system. Bitcoin rewrote that story. It says you can opt out. You can store value independently. You can participate in a global financial network without permission. In 2026, this narrative spreads not through institutions, but through social media, podcasts, and online communities. Young Americans don't learn about money the same way their parents did. They learn from creators, not bankers. And many of those creators openly question traditional finance. This erodes authority, and authority is everything in banking. There's also the issue of scarcity. Bitcoin's fixed supply directly contrasts with the dollar's flexible supply. Banks operate in a world where money can be created through credit expansion. Bitcoin rejects that idea entirely. In 2026, as Americans hear more about national debt, interest payments, and monetary policy debates, Bitcoin's simplicity becomes appealing. Only 21 million, no exceptions, no emergency printing. For banks, this creates an uncomfortable comparison. It highlights how fragile trust in fiat systems can be. Another fear is competition for talent. The smartest engineers and financial minds are increasingly interested in crypto and decentralized finance. In 2026, banks struggle to attract top talent without embracing blockchain innovation, but embracing it too much risks undermining their core business. This creates internal tension. Some departments want to innovate, others want to protect legacy systems.
This internal conflict slows banks down. Bitcoin, meanwhile, doesn't have meetings. It doesn't need consensus from executives. It just keeps running. Banks are also scared of what happens in the next crisis. Every financial system eventually faces stress. In the next downturn, Americans will look for assets that feel resilient. If banks face liquidity issues or restrictions, even temporarily, trust could evaporate quickly. Bitcoin was designed for crisis moments. It was born from one. In 2026, that memory still matters. People remember that banks once failed while Bitcoin kept working. This doesn't mean Bitcoin is risk-free, but it offers a different kind of risk, and diversification of trust is a powerful idea. One of the quietest fears is legal pressure. As Bitcoin adoption grows, banks face pressure to support it. Customers ask for crypto transfers. Businesses ask for crypto services. Refusing these requests makes banks look outdated. Accepting them introduces new risks and compliance challenges. In 2026, banks walk this tightrope daily. They must appear innovative without losing control. But Bitcoin's design resists control by nature. That's the core conflict. Banks want to integrate Bitcoin into their system. Bitcoin exists to operate outside systems. This contradiction cannot be fully resolved. Then there's the cultural shift. Money used to be something you trusted institutions to manage for you. Now it's something people want to understand and control themselves. Educational content about Bitcoin is everywhere. Americans learn about private keys, self-custody, and decentralized networks. This knowledge changes behavior. Once you understand how money works, blind trust fades. Banks depend on complexity. Bitcoin thrives on transparency. In 2026, transparency is winning cultural relevance. Banks are not evil villains in this story. They are institutions trying to survive a changing world. But resistance to technological change usually fails. History has shown this repeatedly. From newspapers to taxis to retail, industries that ignored decentralization paid the price. Banks know this. That's why their fear of Bitcoin is quiet, calculated, and strategic. They lobby, they regulate, they adapt slowly. But deep down, they understand one truth. Bitcoin cannot be shut down the way a company can. It doesn't have a headquarters. It doesn't have a CEO. It doesn't respond to pressure the same way banks do. In 2026, this realization weighs heavily on the financial system, because the future of money is no longer guaranteed to belong to banks alone. It belongs to whoever earns trust, and trust is shifting, slowly, silently, relentlessly. This brings us to the most important moment in this story, the moment when Americans must decide what role banks will play in their lives going forward. Will banks remain guardians of wealth or become service providers in a decentralized world? Will Bitcoin stay a parallel system or become a foundation layer of global finance? These questions are no longer hypothetical. They are being answered every day by individual choices, and the outcome will define the next generation of money in America.